Why your average Cadbury's block of chocolate is about to cost a whole lot more. Crude prices are reliant on OPEC moves, and some decisions from Saudi Arabia suggest the oil market isn't as robust as they'd like us to believe. It's really pushing gold higher, and perhaps it shouldn't be up this high, and the type of uranium ore body to put on your radar. I'm Shae Russell, and welcome to Cocktails and Commodities, the resource podcast where macro analysis meets mining insights. How many clever ways are there to ask you to like this podcast? Trust me, even less than you think. Still, tap the like button for me and even leave a 5-star review. But most importantly, please remember that all information in this podcast is general in nature and not financial advice. It's been over a month since we talked about gold, and a lot has happened in that time. At the end of September, the yellow metal made a stunning plunge from $1,933 per ounce, reaching a 6-month low of $1,819 per ounce. This was a massive 5.8% drop in just 16 days. Gold dived as the market finally embraced higher for longer, a narrative the Federal Reserve Bank has stuck to throughout the year. Yet most punters refused to believe. Come October 6, the yellow metals fall reversed and spot gold surged up on the back of the Hamas terrorist attacks. Gold essentially made a V-shape over the days that followed, and it regained all of its losses and then some. As a gold investor myself, it's easy to get excited about spot powering even higher into 2024. The thing is, how much of today's $1,980 per ounce price is fair value, and how much of it is the war premium? To answer this, we look to data created by Charlie Morris from Atlas Pulse. Charlie Morris created his gold fair value model in 2013, but he's back-tested this to 1998. There's a couple of different variables, but the most important part of his calculation to underpin gold's fair value, which is different to gold's current market value, is that Charlie treats the price of gold as if it were a 20-year US Treasury inflation-protected security, colloquially known as the 20-year TIPS. If you have a precious metal bias, block your ears because you aren't going to like what I say next. Using Charlie's method, the current gold price is considered extremely overvalued. Based on Charlie's maths, the fair value for gold is much closer to $1,282 per ounce. That's a whopping $698 lower than the spot price, the current price of 1980. According to Charlie's method, spot gold has a 55% premium on top of its fair value. It's worth noting too that this is the widest Charlie's fair value model has ever been from the current trading price of gold. We'll get to how the Israel-Palestine war is keeping gold above $1,900 per ounce in a moment. Because frankly, without the conflict in the background, gold would sink like a stone. You must remember there are several headwinds present for gold. For starters, the Fed funds rate sits at 5.25%, the highest it's been in 16 years. With US headline inflation coming in at 3.2% in October, that also means real rates, that is the nominal rate minus inflation, is also the highest it's been in 16 years. Positive real rates, a tightening bias from the Fed, and a reasonably strong US dollar compared to the long-term average are all headwinds for gold. Why? Gold pays no interest. So when rates go up, investors tend to prefer cash at the bank instead of chunks of gold in their safe. Throw in a strong US dollar and you have an adverse environment for gold, which brings us to the Fed and what they will do next. As I said at the start of this podcast, despite jacking up rates for the past 18 months, markets have refused to believe the higher for longer narrative. Yet the Fed has remained steadfast in their commitment to tightening monetary policy. As it stands today, the Fed Funds Watch tool suggests a 47% probability the Fed will only begin cutting rates in May 2024, which is later than most commentators expect. Remember, a lot of the commentators calling for rate cuts have been wrong most of the year. Furthermore, I wouldn't bet the farm on a May 2024 rate cut, as it may still be too soon. Sure, the US inflation rate did fall in October, yet it's still above the central bank's 2 to 3% inflation band. With US headline inflation at 3.2%, It's not high enough to spook the market, and it's low enough to lull people into a false sense of security that rate cuts from the Fed are coming. But remember, 1 month doth not make a trend. Given how the Fed shit the bed on their inflation calls over 2020 and 2021, cutting rates too soon risk leaving the central bank with egg on its face once again. Plus, much digital ink has been dedicated to how the economic environment of the 2020s is eerily similar to that of the 1970s, where stagflation ravaged the economy. The stagflation of the 1970s is in itself too big to cover today, but the economic woes of then were exacerbated by mistakes the Fed made. Most of those mistakes involved cutting rates too soon when inflation looked like it was cooling, and increasing rates again too late after inflation rose. Let's be frank, nobody wants to be remembered for repeating history's mistakes. So don't expect the Fed to cut anytime soon. And frankly, don't rule out a rate hike in early 2024 either. Inflation in the US is down, not out. Let's bring this macro outlook back to gold. Wishing for a leg higher in gold because it favors your bullish bias is not a useful investment strategy. Using the geopolitical backdrop as the reason gold will rally into 2024 is foolhardy, especially when current monetary policy is providing headwinds for gold. But here is the secret to gold's current price movements. Gold reacts to uncertainty. The more unexpected the event, the quicker and higher the spot price will fly. Let me give you an example. The most recent was of that of the terrorist attacks and the subsequent response. Gold reacted similarly when Russia invaded the Ukraine. Gold surged again back in 2014 on rumors the US would invade Syria. Gold also soared when the US invaded Iraq in 2003. But with each of these events, as more information became clear, gold retreated quickly as the uncertain became more certain. While each escalation in this current war is horrific, gold eases and prices these atrocities in, leading us to an uncomfortable adoption of a new normal. Gold rallied hard during the first 11 days of the current conflict because markets didn't know how to interpret what this event meant. Was it an attack, an invasion, a Middle Eastern conflict, or was it at risk of becoming a global war? The current war is now 41 days old, and gold prices have started to ease. Gold falling in recent days suggests the markets aren't as rattled as they were and are now adjusting to what looks like it will be a drawn-out conflict. The Israel-Palestine war is without question keeping the gold price above $1,900 per ounce. Given the current headwinds from monetary policy, if there is no further escalation in this war, keep in mind Charlie Morris's fair value price for gold. Sure, it's unlikely gold will fall all the way down to $1,200 per ounce, but there is clearly a significant war premium factored in to today's spot price. Should sanity prevail and the Israel-Palestine war ends, it will take the wind right out of gold sails. All right, that was a big one. Time to talk black gold. Don't let the $80 a barrel price fool you. Oil demand might be softening. Aside from a final spurt higher at the end of the trading week, Brent crude is currently trading at a 4-month low. Driving the price falls are rising US stockpiles, a shrinking oil rig count across America, Chinese oil refinery production is lower, and the International Energy Association is saying the oil market isn't as tight as it first thought. Despite this, the Organization of Petroleum Exporting Countries says demand is strong and blames falling oil prices on speculators and technical trading. Doubling down, OPEC still predicts demand will rise by 2.25 million barrels per day next year. Yet, Saudi Arabia have extended their 1 million barrel per day production cuts into December, and they'll keep prices for its benchmark crude grade steady for Asian customers for December cargoes. These are two decisions Reuters commodities journalist Clyde Russell says could be interpreted as an admission crude demand is falling. It's worth noting John Kemp, an energy analyst also at Reuters, said most traders were expecting Saudi Arabia and their OPEC allies to extend current oil production cuts at least into March 24. OPEC meet again on November 26, 6 days from now. If demand is so strong, there will be no need to cut production, right? However, if OPEC members make deeper production cuts or continue them for even longer on the back of this meeting, demand for crude isn't as strong as OPEC want us to believe, and production cuts are really about providing price support for the black stuff. Justin wrote to me on LinkedIn to say that one of the highlights of this podcast is learning about the quirks of agriculture, telling me that cocktails and commodities at least makes food shopping interesting. Well, Justin, thanks for reaching out, and this next segment is for you. By the way, my DMs on LinkedIn are open, so drop me a line. Or if you're watching this video on YouTube, leave a comment. I'm pretty active over there too. Now let's move on to the extortionate cost of the average block of chocolate. Chocolate in my house has always been a non-negotiable treat. But in the last few weeks, I find myself increasingly walking past the chocolate aisle. Simply put, the price of a family block of chocolate is too high for it to go in the shopping trolley every week. And based on what's happening in cocoa growing regions, it doesn't look like chocolate prices are coming down anytime soon. A confluence of events is pushing prices up, and there's very little we can do about it. Cocoa has just traded above $3,900 per ton, reaching its highest level in 46 years. Ghana and the Ivory Coast produce 2/3 of the world's cocoa supply. Already the cocoa crop for the 23-2024 harvest, which started on the 1st of October, is expected to be smaller than last year's. Poor weather conditions mean it's estimated this harvest will be down 25% compared to last year. Heavy rain across West Africa has seen the black pod disease spread. Plus, there's a swollen shoot virus which has impacted 20% of the cocoa crops in the Ivory Coast. On top of all of this, looming over the harvest season is an El Nino weather pattern. El Nino often brings drought conditions, and it may reduce the crop harvest even further, also putting pressure on prices. Compounding all of this is the lingering impact of Russia's invasion of the Ukraine. High fertilizer prices are still trickling through the agriculture supply chain. Because of this, the overall usage of fertilizer has dropped across West Africa, but other farms are actually passing the higher cost on. Prices for cocoa are now so high that major multinational cocoa firms are refusing to bid on contracts for the 2024-2025 harvest season. Some are even holding off buying the contracts until the last minute, early next year, in the hope prices will fall. For you, dear listener, this means that the prices you are paying right now for chocolate are based on contracts from October 2022. By the way, that time last year, cocoa prices were 41% lower than today's. Oh, and I haven't even touched on how raw sugar futures are up almost 30% this year, nearing a 12-year high. Why, I hear you ask? Bad weather tied to El Nino is causing unusually dry weather in India and Thailand. So today's sugar prices haven't even reached consumers yet. The short version is your average Cadbury's block of chocolate is probably going to cost even more. Speaking of price rises, though this one has a strong investable outcome, uranium prices continue to soar. Uranium prices are now at $74 per pound. And as discussed in my most recent podcast with Rick Rule, there is still plenty of room for the uranium bull market to run. With all the excitement around uranium, many new investors are flocking to this commodity. But did you know that there are nearly a dozen different types of uranium ore bodies out there? So where does an investor start? To help with this, I reached out to Andrew Pedley from Ilala Metals to explain the 3 most common types of economic uranium ore. It's over to Andrew.
Okay, there are many types of uranium deposit, principally because it's such a mobile or easily dissolved element. It moves into all sorts of environments. But I think let's just touch on the sort of top 2 or 3. The one most people know would be what we call the unconformity type, which historically has been very important and still is. And that type of deposit is where you have 2 contrasting rock types, typically a sort of a sediment like a shale or a siltstone sitting over an older basement. And at that contact, which we call an unconformity, you can have some very high grade uranium mineralization or deposits. And the best known examples of that are in the Athabasca Basin of Canada. There are some in Australia in the Northern Territory up in the MacArthur Basin too. So that's a very important type, and they can be very high grade. I think the highest grade deposits on Earth, up to 18% uranium oxide. But the other key type, and I think it's becoming more and more important, are what we call the sandstone-hosted uranium deposits. They contribute about 30% of the world's production these days, and that's on the up. It's increasing. They're lower grade than the unconformity type. They're anything from 200 or 300 ppm up to thousands of ppm. But very importantly, what's good about those sandstone-hosted types is they're very amenable, or they can be very amenable to what we call in situ recovery of uranium, which is something pretty special. It's where you extract the uranium without mining, without a pit, rather, without underground mine. You actually set up a series of boreholes, basically, and into those you pump normally weekly acidic fluid, or what we call a lixiviant, and that sort of dissolves the uranium in the ground without having to mine it using conventional methods. And the nice thing about that technique is you don't have to make a pit or underground mine. Yeah, the advantages of this in situ recovery, the ISR method, the advantages of that method of mining uranium or extracting uranium is obviously environmental. You don't have to make a pit, and you don't have to make a shaft. You can work the low-grade deposits, and it's also very good in that it's often lower operating cost, which is obviously very nice from an economic point of view. So there are a couple of types of sandstone-hosted deposit. The main two types, so subtype would be what we call roll front, and the other would be tabular. And we're seeing a lot of new projects that are looking at these types of sandstone-hosted uranium. In fact, the deposits of Kazakhstan, they're now global leaders in uranium production. About 40% of the world's uranium is produced in Kazakhstan from in situ recovery of the uranium from sandstone-hosted deposits. The third type I won't talk about much, but is the intrusive, or let's say it's almost like granite-hosted types, uranium in what we call pegmatites, the biggest open-pit uranium mines in the world, in Namibia, in Africa here, are of this type.
Ilala Metals is still a private company, but they're working on an IPO. So keep your ear to the ground for when that opportunity opens up. I've got a couple of other helpful tips for first-time investors in the uranium space. I'll share those with you in upcoming episodes. That's all for this episode of Cocktails and Commodities. Tell me what you thought, leave a comment, ask a question below. And don't forget to be following this pod so you always know what stocks are making news, which commodities are moving markets, and the companies trying to get it out of the ground.